Good Saturday morning to you, everybody. Welcome to the Mortgage Matters radio show and the Connecticut Real Estate Edge podcast, along with Rob Weinberg. I'm Gary Byron. Rob, great to see you, my friend.
Good to see you this morning, Gary.
How are you? I like your shirt, by the way.
Thank you. A little snazzy here.
Yes, it is. And yet it's a Saturday morning, and look at you.
Yes, always got to be dressed to the nines, right? If you look good, you feel good.
So you must be feeling quite nice.
Very good this morning.
How was your week?
Pretty good, pretty good. You know, we're seeing that kind of pre-spring market taking over. A lot of people getting pre-approved. A lot of people out there making plans, and I think it just bleeds over from the New Year's resolutions we talked about. A lot of people nowadays, they have real estate on the forefront of their mind, whether it's financial goals, personal goals with their family. People are buying, selling, financing real estate. It's a big part of it. You know, you're looking for a house.
I'm looking. I can't find anything right now. I mean, we're still, look, it's mid-February. I get it. You know, if this were mid-May, I'd be panicking, but it's mid-February. I'll give it another month, and I'm kind of thinking by when we start getting into middle to end of March, I kind of think that the inventory will increase, but right now I'm not liking what I'm seeing.
You just got to stay the course and be patient now. We are turning a corner. There will be more opportunities. You're well positioned. You're pre-approved and ready to go.
Wow.
That's the main thing, is getting ready. So many people think, oh, I'll get all that prep done when I find the house, and that's wrong. It doesn't work. Period.
All right. So, but to that point, let's say I wake up tomorrow morning and I see a house, and I'm like, geez, you know what? I better strike while the iron's hot. A lot of things happen so quick. Mm-hmm. Do I call you, or do I just tell my agent and say, I'm putting in an offer? Yep. This house here goes for $350.
You'll have a collaboration with your agent.
Yeah.
Tell them, here's the address, here's what I'm looking to do, here's my general numbers. They'll craft the offer with you. They'll put in the offer for you. That's their job. So you're ready, though. You already have the paperwork done with me. You have your pre-approval letter. Now it's your agent. We pass that torch to your agent now. Alan, in your case, Alan Grover.
Yep.
And he'll take it from there. He'll get your negotiation done. Then it'll come back to me once your negotiation is accepted, your offer is accepted, and you're moving full speed ahead. Then I get back involved we'll process and get that mortgage going. So, you know, on this show, we cover so much residential stuff about people just like you buying their first or their second home.
Sure.
And I've gotten so many questions from people about the other side of it, the investor side, the commercial side.
Oh, yeah.
People looking to really expand a portfolio, buying Airbnb properties
Ooh.
so often, vacation homes, rentals, that sort of thing. And, you know, I'm not the expert on that. I've dabbled in it here and there, but I'm not the expert. So I had been racking my brain, you know, on who can we bring on, who's a real expert in that area. And the light bulb went off. I was talking to a friend of mine a couple weeks ago, a college friend of mine. We started in the mortgage industry at the same time. And Andrew Shanti. Andrew is a great, great friend of mine, professional colleague. We've been in the industry for, 20 plus years together, or close to it. And he just has a different direction than I went. I went more the residential, owner-occupied, second home type of way. He went the investor, commercial, the business purpose type of loans. So that's my special guest today. And I think probably one of our most eccentric, most valuable, most knowledgeable guests, Mr. Andrew Shanti.
Andrew, nice to meet you. Welcome to the show.
Hey, Rob. Hey, Gary. Pleasure to be here. Thanks so much for having me on. Really excited about this morning's call.
No, so am I. So you're like Rob said, he's more residential, and you're both residential and commercial, but for investment purposes, right?
You got it. Yeah. So I'm strictly on the investment property side, whereas as Rob is dealing with the average homeowner who's just looking for the best deal on their home. I'm on the flip side of the coin, so I don't deal with anyone just buying a home to live in. I strictly deal with real estate from the investment side.
Yeah. What are the key factors then to consider when investing in real estate with a mortgage?
So when you look at real estate as an investment mechanism, like all investment vehicles, the most important thing is making money.
Right.
Yeah.
So investment real estate is all about cash flow, or there's a couple different sectors, right? When it comes to investment real estate, you've got people that are buying homes that are run down, blights to the community, and so they're going in, picking them up at a discount, rehabbing them and bringing them back to their former glory or into another beautiful property, right? So that's one investment vehicle is your fix and flips. And then you have the other investors out there that are buying a property strictly for cash flow, whether that's just a long-term rental, someone's coming in, putting in a tenant who's going to live there for a year or two, or someone who, like Rob said, is going in and buying like your Airbnb or your Vrbo property that's using it as a more active investment where you've got almost like a hospitality model of people coming and going, 2-3 times a week. So you've got different strategies that are taking place. But at the end of the day, it's all about making money with real estate.
There's differences, though, right, between a conventional mortgage and the investment mortgage that you're alluding to?
Significant. So I'm on the hard money side of the industry, which there's a lot of misconception as far as, what a hard money loan is or what a hard money mortgage is. And I run into this all the time. Almost every single pre-qualification letter that I'll send into a real estate agent, I immediately get a phone call from the real estate agent saying, hey, what's hard money? What is this? I don't know what it is. My seller doesn't know what it is. And usually by the end of that call, my offer will be accepted by the seller just by the way I explain it to them. So on the conventional mortgage side, the qualifications that underwriting is looking for is they're looking at income, they're looking at your credit score, they're looking at your job history. They're looking at the 5 C's, right? Your basic qualifications of, hey, is this person going to be able to pay for the mortgage long term? On the investment real estate side, we are the complete opposite of that. So we're looking at the specific property's ability to pay the mortgage over time. We're still concerned about credit, but we don't care about job history. We don't care about tax returns. And our mortgages also don't show up on people's credit reports like a conventional mortgage. So they're considered business purpose loans. And because they're written strictly for non-owner occupied properties, we've just got a ton of flexibility in how we structure them, how we put them together. Just the options for actually bringing the loan across the finish line are night and day different than the conventional mortgage process. You're going to end up with more leverage on a conventional mortgage a lot of times, right? So on a typical purchase in a conventional mortgage, you're going to get up to 90% financing for just like a regular property. On the investment side, you'll get, say, 80% on a rental. So you're not going to necessarily get as high leverage, but the ability for you to not care about job history, not care about your tax returns, not care about like a lot of the things that will tank a conventional mortgage or make it very difficult to finance. That's the world that we live in the hard money world.
Andrew,
also, yeah.
I'm sorry. No, please continue. I didn't want to interrupt you. I thought you were done. I did have a question. I did have a follow-up question to that, though.
Yeah. Also, one of the big misconceptions when it comes to hard money is people think hard money and they think there's a shark swimming in the water coming at them, ready to take their property away from them. That's really not the case. So when we say hard money, what's being referred to as the source of the capital that's behind us. So when you're doing a conventional mortgage, you have Fannie and Freddie, or you've got the federal government that's behind you buying those mortgages. In the hard money world, you have hedge funds, private equity companies, you've got health insurance, life insurance companies, et cetera, private pensions that are behind the scenes providing the capital because they're getting a higher rate of return than they would with conventional mortgages, i.e. like buying notes. So when I say a higher rate, there's 2 different sides to the the investment real estate world. There's the short-term side, which is your bridge financing. It's typically a 12-month, 18-month, or 24-month interest-only loan with no prepayment penalty. Whereas on the rental side, you're going to have like your traditional 30-year mortgage, whether it's a 5-year ARM, 7-year ARM, 10-year ARM, et cetera. But it's always going to be based around a 30-year mortgage, right? Rates on the short term are going to be higher. You're looking at 9, 10, 11, 12%. But when you're looking at like a long term, even in the hard money world, our rates can be anywhere from about a quarter to a point and a half higher than what you would see with conventional mortgage financing. So it's not necessarily all that much more expensive on a long term. We call them a DSCR, which is a debt service coverage ratio loan, which is just basically the property's ability to pay the mortgage based off of cash flow. That's what's referred to by that. So on those loans, we're just slightly higher than the conventional financing would be. So big misconception there is that hard money's got to be super expensive. Back when conventional rates were around 3.75, I was doing 80% financing at 4.25, just for a comparison. So it's really not that much higher than conventional financing.
I've been surprised seeing Andrew price out some deals and things at how competitive the interest rates are. Because like he said, most people think when you're getting into this hard money or private capital, it's going to be these obscene rates of 12, 15% plus, like credit card interest rates. And it's just not. I mean, there's been times when I've looked at pricing with Andrew and it's comparable or very, very close to the same loan on the conventional side, because I think the important thing our listeners understand is that there's a push away from Fannie and Freddie and conventional with investors. They're trying to get away from helping people build their portfolio, whereas these type of programs Andrew's talking about are designed for real estate investors. They're really meant to help and spur activity in that, whereas the government side, the Fannie Freddie side, and I just heard an announcement last week, like they are pushing investors out. They're saying, if you're trying to profit with our money, we're going to make it really expensive. Doesn't mean it's impossible. It's just really expensive. So if they're making it so much more expensive, all of a sudden Andrew Optimus come in with this great, capital source that's going to be comparable, like you said, maybe a quarter, a half a point higher. It's not even worth it. Why would you even mess with a conventional loan? This is so much easier, less friction, less paperwork, and it's not that much more expensive.
It's a commercial loan, though, right? It's not considered a residential loan.
I think, Andrew, it's considered like a private money loan, right? Private
business purpose loans is what they're called.
All right.
So they're not on your personal credit report. That's huge.
Okay, so it's for commercial purposes. You wouldn't be living there. Okay, so
Right.
a quarter, a half a percent more than you would for your home. What about the length? Is a commercial mortgage, can that be 30 years like a residential mortgage?
They're actually all 30-year mortgages on the long-term side. So we don't have like the 15-year, the 20, 25-year mortgage on the hard money world. It's all going to be based around a 30-year mortgage.
Okay. All right. Now, what about pre-occupancy or compared to vacant?
That doesn't matter. So if someone is buying a property, we're going to qualify that property based off of, say, market rents, right? So when an appraisal comes back, there is a part of the appraisal which has a market rent schedule when we're doing mortgages for investment properties. So you don't necessarily need somebody in the property when you're buying it. We're just going to qualify it based off of the potential cash flow. Now, this is what gets interesting. So when we pre-qualify a borrower, right, and say they qualify at 20% down on a purchase, the other thing that we're looking for is we're looking that they have their 20% down, their closing costs, plus at least 6 months of interest reserves, such that they could make the mortgage payment for 6 months before the property takes over and pays for itself. So that's kind of part of the underwriting guidelines as far as qualifications, as far as like liquidity.
Okay.
We just want to make sure that you've got at least 6 months of payments covered. Those aren't impounded or escrowed. It's not just sitting there in a bank account. We just want to make sure that you have the money,
all right,
that you could support it while you're getting a tenant or rehabbing it or staging it or whatever you're doing to the house to make it viable as an investment medium.
So it makes no difference if I was purchasing a commercial property. And let's say 3 units, I don't know, a restaurant, I don't know, whatever, it's irrelevant. But let's say there's 3 units under one roof. Whether they're all occupied when I purchase it, or if it's only 1 occupant or 2 occupants, or there's 0 occupancy, that doesn't even factor into me obtaining that commercial mortgage, you're saying?
Makes no difference to us.
Gotcha.
You got it.
Okay. So how do you determine? Well, go ahead.
Now, if it's a refinance, different story, right? So if someone is trying to pull cash out of a property or they're just trying to refinance it because their note came due, in that situation, we're going to require that there is a tenant in place unless they're going short term. So once they're actually into the property and it's operating, they've got to have a tenant in place with a signed lease they can provide to us when they're refinancing.
Gotcha.
Just not on a purchase.
How do you determine the best type of mortgage for your real estate investment? There's many different types. How do you know which is the best one?
So I always stick with the old adage, cash is king, right? So the name of the game for a real estate investor is making as much money as possible. So when you're looking at the different types of products that are available, it's really important to understand what is the long-term goal of the real estate investor, right? Because you have short-term investors and you've got long-term investors, and they're each approaching the market in different ways. So, for instance, a short-term investor is going to be like your fix and flip guy, right? They're trying to get in and get out as quickly as possible. On a fix and flip loan, we can get really aggressive as far as like our financing terms. We can do up to 90% of the purchase, 100% of the rehab costs as reimbursements back to the investor, up to 70% of the after repair value for a first-time investor that has no previous experience. Super aggressive. Now, you're going to be paying, again, like 10.99, 11.99, 12.99% interest. But if you're in and out of that loan in 3 months' time, then you may have really only paid 3 or 4%. So when you look at the big picture of it, it sounds really expensive, but the name of the game is to get in, fix the property, sell it, and get out. So
it's about return on investment. If you're paying
100%.
12.99, but you're making 30% on that deal for the time you hold it, simple return on investment. You got to like detach yourself emotionally from double-digit interest rates and look at it as a business transaction, because these are business purpose loans for business people, for investors. So it's not that's too high. It's my return isn't going to be high enough to justify that higher rate. But typically on these type of deals, if you're paying 11, 12, 13, 14% mortgage rate, you better be making 20, 30, 40% on your capital, right? Then it's a good deal. But if you're paying the high double-digit interest rates and you're breaking even or barely, there's not a lot of meat on the bone, so to speak, not worth it. These are not the right loans for that type of person.
I got you. So what are then, Andrew, what are the current trends in the real estate investment market? And really, how do they affect mortgage rates?
So it's really interesting. On our side, I like to think of real estate investors as probably some of the most aggressive entrepreneurs you'll ever come across. I love dealing with real estate investors because every decision they make is just a dollar and cents decision. It's just a financial decision for them. There's nothing. They're not falling in love with the real estate because they're not living there. It's not something they look at every day. It's just to make money with, right?
Sure.
So that being said, the approach that they take with it, whether it's short-term or whether it's long-term, determines everything, right? So the biggest trend right now that you're seeing is probably the short-term rental market and the amount of money that people are making, right? So perfect example, you could have a long-term rental property that you're only making, say, $1,500 or $2,000 a month in rent on. That same property as a short-term rental might make $5,000, $7,000, $8,000, $9,000. It's been in a really good market, i.e. like a beach town or a ski community or something that has a lot of draw to it. So it's a more active investment type. You've got to be a lot more hands-on, but the return on the property can be significantly higher than a long-term site would be, just a single renter in there. I mean, it's just night and day difference. So you've got a lot of operators out there that have really mastered the short-term rental game, your Airbnb and your Vrbo properties, and they're making six figures on a property. They're bringing in 100,000, 110, 115. I've seen some of these properties that are making several $100,000 on just a short-term rental, guaranteed. They're in some more expensive markets like your Vail, your Aspen, your Hamptons and places like that. But the amount of money that they're able to generate is just unfathomable for an investment property. So that's been a big trend that really took off during the pandemic. You had a lot of people that didn't want to go to hotels, right? They wanted to go someplace away from people with their family and just check out, either be in nature or be close to the beach. It's just a different experience, right? So you had this huge influx of people that kind of poured into that space and bought all these investment properties and have done phenomenally well. Now, as COVID's kind of backed off, the pandemic's we're coming out the other side of it. People have started going back to hotels and things like that. Some of that income has dropped by anywhere from like 15 to 30% on the short-term rental side from where it was a year or 2 years ago, from what I hear from really major operators, like the guys that have 20, 30, 40, 60 properties that they're running short-term rentals.
Right.
So their numbers are down, but they're still making certain times $3,000, $5,000, $7,000, $10,000 more a month than they would on a long-term rental. So that's one of the huge kind of things that's been happening in the marketplace is just kind of the movement into those higher returns with a more active real estate investment.
I got you. Give me 1 second here. Folks, you're listening to Mortgage Matters radio show and the Connecticut Real Estate Edge podcast, along with Rob Weinberg. I'm Gary Byron. Our guest this morning is Andrew Shanti. He's with Optimus Capital. You can check him out online at Optimus Capital Corp. That's OPTIMUS Capital with an A, Corp.com. And he can be reached at 954-598-4564. I'll repeat all of that information as well as Rob Weinberg's information in a few moments, more towards the end of the show. I want to go back to Andrew for a moment. How do you evaluate the potential return on investment for a real estate property?
Great question, Gary. And so one of the really wonderful things about real estate is you can really forecast real estate and the returns on real estate in a way that you can't do with a lot of other speculative investments, right? You never know what's going to happen with the stock market. You never know what's going to happen with commodity prices. There's just no way to kind of forecast that.
Right.
Real estate's a different animal, though, because everything in real estate is predicated on historical data, right? So if you're going to rent your property in, say, Connecticut, right, you're going to have a situation where your rent is going to be alignment with market rents in that area. You can research that. You can talk to a property manager. You can talk to a realtor. You can pull up on like a Zillow, and you can figure out almost to the dollar what your property would rent for in the marketplace. You can look it up online. It's public information, right? Now, what you can't do is you can't really speculate with real estate and just have to bank on the fact that the value of it is going to keep going up. That's market determinant, right? That's cyclical. You have markets that go up, markets that come down. So if you're investing in real estate just hoping for appreciation, you're gambling, right? You're just rolling the dice and hope the market keeps going in your favor. However, if you're approaching it and looking at it from the fundamentals of, hey, how much money, what's the rate of return on my capital? I put in $30,000, $50,000 into this property, and now it's paying me out $20,000 a year. Look, $20,000 divided by $50,000 is going to be your rate of return. That's a phenomenal return on your investment for the amount of money that you put in. And it's not speculative because all you've got to do is keep somebody in the property.
So that's how you assess the risks?
Well, that's really the potential return. That's the return. There's another one. There's another thing, risks, though, to be looking at, or what are the potential risks?
Yeah. How do you assess that?
Yeah, Andrew, what do you think when it comes to the risk?
On the risk side, right, it's really market dependent. So if you're in an area, I mean, let's take like what's going on in like Jackson, Mississippi, right? You have a situation where you've got like the water system or the plumbing system of an entire area has broken down, and they're saying could be years before they're able to get it fixed. Certain areas like that are, you're going to look at that information and say, well, that probably is not going to bode well for that real estate market for the next couple of years. So certain areas like that where you've got just news, right, or bad news coming in, you want to stay away from those unless you're getting a really good deal, right? Mm-hmm. So you want to look at what's going on in the local market, and you also want to make sure that what you're doing is sustainable, right? So if you're going off of market rents and you're doing a long-term mortgage, you're going to be golden. You just got to keep up the property and, make sure you're paying your mortgage every month. Now, on something like a short-term rental, right, you've got to be a lot more careful, and you've got to make sure that, say, for instance, the county is not going to go change the zoning on you, which has been happening in a lot of different places, like especially like Hawaii, right? You have a lot of investors that went into Hawaii, bought a short-term rental property, and then one of the islands changed its zoning so they can no longer operate it as a short-term rental. Well, in a situation like that...
But you're not grandfathered in?
Not necessarily.
Oh, my goodness.
In certain instances, yes. In certain instances, you just get thrown to the curb.
Andrew,
I mean, it even happened. Yeah.
I'm sorry. I'm running out of time. There's really a key question I wanted to ask you, but I'm going to have to ask you for a short answer to it, sadly enough, because the clock is my enemy here, my friend. Just some of the common mistakes that first-time real estate investors make when securing a mortgage. I don't know if you've got a quick 1-minute answer to that, but that's all I really have.
Yeah, not doing enough research.
Yeah.
Bottom line, if you haven't done enough research and kind of explored the positives and the negatives, look, you can't just look at the positives. You got to look at the downside. And if you're not, then you're putting yourself in a risky situation where you could lose out on it, right? So research. Know your numbers. Know that you're getting a good deal, and know that you're going to be able to pay your mortgage.
I would imagine creating an LLC, too, so that you're not personally held liable and nobody can come after your personal home, your residential home, right?
100%.
Yeah.
In fact, on the hard money side, a lot of our industry won't do a loan unless it is in an LLC or being made to an LLC.
Perfect. What I want to do is provide some information on how people can reach you. Again, we're talking with Andrew Shanti from Optimus Capital. He can be reached online at his website at optimuscapitalcorp.com. That's optimuscapitalcorp.com. And here, write down his phone number. It is area code 954-598-4564. I'll repeat that for you really quickly. Area code 954-598-4564. As for Rob Weinberg, well, we tell you this every show. Easy website. It's robgw.com. His website hasn't changed. It's robgw.com. Mortgage Matters Radio Show at gmail.com. And, of course, his phone number, 860-413-3938. I'll repeat that for you. I'll slow it down if you want to write it down. I know it's the weekend. You can call him today. You'll get his voicemail. You can always leave him a message, or you can call him first thing tomorrow. 860-413-3938. Again, I want to thank our guest this morning, Andrew Shanti from Optimus Capital. Thanks for being with us this morning. For Rob Weinberg, I'm Gary Byron. Thank you so much for listening to Mortgage Matters Radio Show and the Connecticut Real Estate Edge podcast. Until next week.